Over $1 trillion has been wiped from software stocks. Traders are calling it the SaaS Apocalypse because to them it feels like the end of a technology business model, software as a service, and we're now weeks into this giant sell-off and it's only accelerating. In this episode, I'm going to dig into why markets are panicking, why Thomson Reuters can post what seems like such strong earnings and yet still lose 20% of their valuation in a single week, and what the SaaS CEOs themselves are actually saying in response. It's important to remember that SaaS stocks and technology stocks are the only reason really the market hasn't collapsed around the world. They are quite literally propping up the world economy. I'm going to look at exactly what Jensen Huang and Klarna's CEO got right and wrong, why I think a per-seat pricing model, i.e. the business model, might just be broken, and what Sam Altman means when he says every company is now an API company. And as always in this podcast, I don't think the real answer here is in the stock market. And in fact, that's the least interesting part of today's discussion. I'm going to look at what happened when the creation costs collapsed to zero in music and photography, and how the industries didn't die, but the business models themselves broke and then were rebuilt. And I'm going to argue that I think the same is going to happen in SaaS. This is In the Loop with Jack Horton. I hope you enjoy the show. I'm going to apologize in advance if you hear sipping of coffee. I'm absolutely shattered this morning and just trying to keep myself awake. I think it's important to start with, I guess, what's actually happening in the market. Now, I'm not going to spend too much time here, don't worry. I know some people probably find it quite interesting. I do find it interesting from an investments perspective, but really it gets quite boring quite quickly. And I actually really want to jump into the history and the interesting parts, to be honest, to help us understand where this could probably or likely could go. So recently, about 3 or 4 weeks ago, a CNBC reporter actually sat down on a news channel and to see if she could build a $5 billion software company as an application herself. Now, Deirdre Bosa had no engineering background, of course. She just opened Claude, described what she wanted in English, and an hour later had a working project management tool that was plugged into her calendar and a Gmail. And it surfaced kids' birthday parties that she'd forgotten about. The total cost was probably about $20, maybe, in compute credits. You know, in that same week, $830 billion in market value was lost because of software stocks. Salesforce, Workday were both down more than 40% over the last 12 months. HubSpot fell 39%. Atlassian fell by 35% in a single week. Unity, the company that allows people to build games, so an incredibly important and big platform, lost a quarter of its entire value in a single day because Google released a new model that can literally generate playable 3D worlds from just natural language. This has been called by traders the SaaS Apocalypse, with people calling it essentially, and when I say SaaS for all those that don't know, it means software as a service, but many people are calling it an apocalypse of software as a service as a business model. So paying monthly amounts of money for software. And you've got hedge funds now all over the world shorting, so betting against giant companies. And in total, they've bet over $24 billion that software stocks are going to start to go down in 2026 alone. I know we've talked about this a number of times on this show. And now the catalyst of this latest wave of, panic everywhere was, of all things, a legal plugin. So when Anthropic released Claude Cowork plugins, so you might have listened to the Claude Cowork episode, I recommend you to do that. Well, since that episode, they launched something called plugins. Now, plugins are basically an ability for an agent to follow a process in a really simple way. Now, this isn't anything new, but it's essentially copied what coders have been doing for some time and brought it into, I guess, general knowledge work accessibility. And suddenly, Cowork could do contract reviews, NDA triages, compliance checks. And that means that suddenly a lot of companies that were making a lot of money in that sector suddenly lost a lot of money. Thomson Reuters fell 18%, LegalZoom dropped by 20%. The list goes on. And essentially what we're watching, or the market is watching, is AI companies release what are free tools or free additional tools to their quite affordable subscription that everyone's using. And as a result, immediately reprice an entire software sector. And it just keeps going. This wasn't a blip. It's becoming a major trend. Perhaps the most telling case study is that Thomson Reuters that I've mentioned a few times, because during their sell-off, their stock had fallen 20% in a single week. And yet the actual earnings, so the revenue that they had actually grown by, was really strong. 7% revenue growth, 9% growth in EBITDA profits. So the actual money they took home, margins were at 44%. These aren't small numbers. These are really impressive. And the CEO came to the market and said, we're seeing massive benefits from our investments in AI. And they had planned to scale up new agentic features across their platform. So yeah, strong results right now. So strong revenue results from big businesses are meaning very little in the market right now because people don't have much belief. Because ultimately, and I'll explain why this is happening, good numbers today still leaves existential questions for tomorrow. Now, again, as I said at the beginning of this episode, the software level, debate and the market debate, is software dead or, isn't it? Isn't something that really interests me that much. It's a really important question. It's a big question, but it's pretty obvious. Of course, software isn't dead. The more interesting question, I think, is what happens when the cost of creating something collapses to almost zero. Because we've seen this before several times in history, and I'll tell you about it because I think it's really important to help us understand what's actually going to happen. And just remember, this has huge ramifications for the global market, for the global economy, because tech stocks are predominantly propping up markets right now. What happens when the cost of creation collapses to almost zero then? Let's go into it. In 1972, you'll tell this is very fun for me to research and read about and get stuck into. The Rolling Stones spent about $2 million and over 3 years recording Exile on Main Street. So yeah, studio time was about $800 a day. And major label album budgets were about $500,000, and that was before any marketing was happening. So suddenly now today you can record an album on a laptop basically for free. An AI tool like Suno will generate an entire song from a single prompt, and again for free. So the barrier to creating any good music or any music at all went from millions of dollars to basically nothing in 40 years. And obviously the music industry hasn't died. It completely restructured, and the story about how it restructured is particularly relevant and interesting for this discussion. So US recorded music revenue actually peaked at about $14 billion in 1999. Yet 10 years later in 2009, it collapsed completely to about $6.5 billion. CD sales lost 76% of their volume and their revenue. The creation side of the business was completely destroyed. And obviously everybody was panicking, just like what's happening in the technology sector today. But then something quite interesting happened in 2009. Revenue not just recovered, but actually exceeded that previous peak. By 2024, US music revenues actually hit $17.5 billion, which is the highest in history. And streaming actually had accounted for about 85% of that total number. And meanwhile, live events were making about $23 billion in revenue. So from concerts and from meetups and clubs, with 150 million fans attending about 50,000 events in the US alone. So yeah, the industry didn't die. The value just shifted. It migrated from creation and licensing to distribution and live experiences. And Spotify obviously captured a huge amount of the revenue that most of the labels lost. And you had Taylor Swift's Eras tour last year gross about $2.5 billion, because the one thing you cannot truly digitize is an amazing, live experience. And we had the exact same happen in publishing. In 2005, about 280,000 new titles were published in the US. Yet by 2021, that number had crossed about 3 million. So from 282,000 to 3 million, tenfold increase. Yet the actual total revenue from the book industry hadn't moved at all. And the only real ones that made any money, of course, was Amazon, and that's because they own distribution. Photography was the same. Stock Images made a huge amount of money from owning images and then licensing that to companies and photographers for money. And obviously when AI image generation arrived, everybody completely panicked. But actually Shutterstock are now earning record revenue from not selling photos, but basically licensing its imagery for AI companies to train their AI language models on. Suddenly, it's training data that is the value. Again, value is shifting. So yeah, every time the cost of creation collapses to zero, we see a very similar pattern play out. The volume of that thing explodes, per unit economics, so the value of selling each unit collapses because the thing isn't scarce anymore, it's everywhere. And therefore, the industry must completely restructure around whoever controls distribution and what can't be commoditized. The thing itself never dies, just the value people place on it economically changes. And this is mirrored in over, I think, 160-year-old economic theory, which is the Jevons Paradox. And essentially, this is when a thing is made massively cheaper and accessible, the number of applications built with that thing increases. So, for example, we saw this when coal became affordable. Suddenly, there was an explosion of factories in the industrial era. And now we can apply this to software. If AI can make it 10 times cheaper to create technology, we won't use a tenth as much, we'll use 100 times more of it. However, the Jevons Paradox also tells us what's going to happen to many companies in this space, because more total consumption didn't mean that every existing producer will suddenly get richer and be successful. When coal got cheaper, although total consumption of coal went through the roof, many individual coal producers at that time completely went out of business. And so when recordings, we saw this in the music industry, when recording costs collapsed, although more music existed than ever, and this is still the rule today, most musicians earn less than ever before. The pie gets bigger, but the slices are also much thinner. And Ben Thompson put it well in his Stratchery piece, which is a fantastic place to go learn about what's happening in the stock market. He said that the real risk I see for software companies is the fact that while they can write infinite software for much cheaper thanks to AI, so can every other software company. The growth story for all these companies is in serious question, and the industry-wide re-rating seems completely justified to me. And essentially what he's saying is that because every company can produce lots of software for the same affordable price, everybody's narrative around we're building XYZ to have differentiation that other people can't replicate and that we're providing and delivering value that no one else could beat us on, suddenly that story feels less compelling, because it is actually true that a startup or another company that's just as big could replicate exactly what you're investing in and building really easily. And suddenly the things that used to feel less important, so maybe relationships you have with vendors or good marketing, good branding, maybe that's going to become more important, whilst the technology technically becomes less important. Now, I don't want to just, present a one-sided discussion here. There are many interesting counter-arguments to this, and I do want to give weight to the other side. So yeah, on February 4th, Jensen Huang, for anyone that doesn't know, is the founder and CEO of NVIDIA. He stood up at the Cisco AI Summit and called the software sell-off the most illogical thing in the world. His thought experiment was quite simple. Suppose we are the ultimate AI, artificial general robots, and if you were a human or a robot, would you use a screwdriver or invent a new screwdriver? Most of the time, you would just use the screwdriver that already existed. Would you use a hammer or invent a new hammer? And so then he just extended that to the digital realm. If we're an artificial general intelligence, would you use tools like ServiceNow and SAP and big companies that exist, or would you try and reinvent them? It's a genuinely good argument. I'm not sure I'm fully persuaded by it, but the idea is that AGI would just rebuild every digital tool from scratch rather than use the best of what already exists. Sounds quite silly when you put it like that. And it's not just Jensen Huang that says this. The SaaS CEOs themselves aren't panicking, or at least they're not publicly panicking. So Box CEO Aaron Levy argued that the narrative, and I quote, sometimes and somewhat misunderstands this idea of where companies tend to spend their resources and their time and energy. His pitch basically is that, SaaS companies are going to build agents on top of their existing products and make their SaaS subscriptions just as valuable. Therefore, AI is an opportunity, not a replacement. And he called it the most exciting moment in the last 20 years of technology and cloud software. Salesforce CEO Mark Benioff said the exact same. He said the agent force, so their product for building agents, is the fastest growing product in their history. And he points to the fact that they own customer data and that is their moat. And then there's also the enterprise argument, which is that large organizations don't run on small little apps. They run on decades of layered systems and, data warehouses, custom services, very shaky integrations, compliance being really important and everyone being very worried about compliance. And, markets can move on what they think is true, but that doesn't mean enterprise businesses and architecture can move that fast. They are going to be quite risk averse to just use small little apps spun up by Claude in a minute. Those timelines for change is very different. And finally, there's also the market-based counter-argument, because actually you can kind of point to this almost logical contradiction with everybody getting very scared. Because for the technology sector to collapse, it requires two mutually exclusive things to be true at the same time. The AI capex is essentially deteriorating. That companies are spending a huge amount of money on AI and the profits aren't clear, which is what a lot of people say. Whilst at the exact same time, AI being so effective and successful that it's spreading everywhere and reshaping how technology works and therefore makes technology worthless. And you could argue that two of those things at the same time make no sense. So therefore, this kind of negative bear case that we should all take money out of the stock market of technology stocks is a little bit illogical. Now, anyway, I think where I land on this is every single company is at risk of being replaced by an AI native competitor who offers an infinitely better experience, a faster experience, and one that solves problems, and for a much more affordable price. Because ultimately, yes, things take a long time to change. I think it's worth remembering, that BlackBerry wasn't protected, Kodak wasn't protected, Blockbuster wasn't protected, or shall I say, it was protected until it suddenly wasn't. The timeline might have been longer than, maybe people like myself or others predict. It's almost always the case. But it's always much shorter than the big incumbents, those that are at the top and have all the money and power. It's always shorter than they assume. And then suddenly all this delayed disruption tends to arrive at once, rather than suddenly just gradually. Because by the time everybody realizes it's already changed, it's kind of too late. Anyway, so I think from here, I think it's going to be really interesting. What therefore does software become? Because this is the really interesting question. Not whether software stocks recover or survive. I think what software becomes on the other side of this massive change is something that I'm really interested in. So first, the business model is completely breaking. So traditionally, most technology companies sell on users, or a lot of them do. Suddenly, you are buying software for humans to use, but if you're buying it for agents to do the work, therefore, if your product is charging by the user, you're selling essentially a tax on productivity. And even if companies keep their SaaS subscription, and many, many will, if they're slashing headcount because AI lets tens of people, if they're slashing headcount because, let's say, AI might let just 10 people do the work of 100, they don't need 100 seats on an application anymore. So that per user pricing model that a lot of the SaaS industry runs on faces a massive existential question. And when CEO of OpenAI, Sam Altman, was asked, is software dead? He responded a little bit differently, which is every company is now an API company, whether they want to be or not. And what he's basically saying is that interfaces are no longer important. It's the outcomes an agent can perform for people as a result of the APIs companies make available. So essentially, letting an agent use their system regardless of what interface they're in. And most likely, he wants everybody to be in the ChatGPT OpenAI interface, and every other company in the world becomes, I guess, a back-end system. So you can speak to your Spotify, for example, through OpenAI. But if that becomes true, the value is not the interface. And mindset, we've been saying this for quite a long time. Every chatbot looks the same. You should do a good job of it, but actually what's really important, it's actually the actions that an agent can perform on behalf of users using your APIs. And APIs compete on price and functionality, not on complex UI. Now, this connects to the second thread. What happens when AI chooses the tools? Jensen Huang's screwdriver argument assumes that a human is picking a tool off the shelf based on some form of brand familiarity and trust. But that's just not how our AI agents will work. They'll select the optimal tool based on, measurable data, costs, speed, functionality, and those criteria are changing all the time. It doesn't care about UI, doesn't feel the switching cost friction, has no brand loyalty. If a better option just shows up tomorrow, it'll just switch. Now, if this becomes true, and we actually delegate tool choice to an agent, which I'm unconvinced by, but it's a potential interesting discussion, suddenly SaaS business models again face the potential collapse. Third, the quality question. One of the comments that hits hardest in this whole debate is essentially most of these SaaS products weren't that good. It's hideously broken a lot of the time, like really bad UX and bugs and functionality that's obviously missing. And he's right. If anyone's used enterprise software on a day in, day out basis, they'll probably all share the same thought, which is, I want to rip my hair out. The bar for quality has already been low. So when suddenly they face this existential threat, maybe we'll finally get software that's really good because they have to compete on quality for the first time in history. So therefore, it might not be the death of software. It might be the birth of software that is actually good and doesn't make me want to throw a laptop out the window. And fourth, and this is something I'm seeing consistently as a pattern, temporary software. So software that doesn't exist as a permanent product that you'd subscribe to. It's software that's generated for a specific task, used once, twice, maybe 3 times, and just thrown away. Software as a verb, not a noun. Developers and analysts are already seeing this pattern everywhere. You don't buy a project management tool. You might describe what you need for a specific project, and an agent assembles it. You don't subscribe to an analytics dashboard. You ask a question, and the dashboard materializes around them. This is what mindset enables companies to offer to their customers. Essentially, a chat interface with loads of components or widgets that an agent can pull together for a person, and then they could go on with their day once they've used it. Even our VP of sales, non-developer, uses this for key deal review. So instead of using HubSpot to go through which deals are we looking to close, he creates a app which is essentially a report that's interactive and can leave notes on it. Now, it wasn't connected to a backend, so it was quite temporary, but that's a problem that's going to be fixed by someone like Claude very soon. Everyone could just describe the task they're trying to complete, and it's done. To conclude, I think the mistakes many people are making here when we say is software dead is treating this as some binary thing. Software obviously isn't dead. Software as we know it might be dying. We're going to be surrounded by a dramatically different landscape with a lot more software than ever before. The Jevons Paradox guarantees that. When something gets cheaper and easier to create, we don't use less of it, we use more of it. But the software era of the last 10 years, which is that specific economic arrangement of packaged products as technology, charging, an amount of money per user, per seat, with annual 12-month contracts that you have to sign, with moats built in to the fact that their UI is complex and difficult to navigate, might just be over. Software has been valued typically at 30 to 35 times profit for the last 15 years. And a lot of this is because the market assumes that these big companies have 10, 20, 30 potential years of being market leaders. But if AI contracts that horizon, so makes that period instead of 30 years, suddenly 5 years or 8 years or less than 10 years, then we'll reprice those technology companies. The valuations won't be 30 to 35 times. They might be 5, 10, or 15 times. But remember, the music industry in 2024 is still bigger than it was in 1999. Now, if you're a CD manufacturer in 1999, that stat means very little because you're out of business. But the software industry in 2035 will, I guarantee, almost certainly be bigger than it is today. The question is really whether it's bigger in a way that companies currently selling can capture, or whether the value has already migrated and changed, and most of those companies are going to die out. Anyway, I hope you enjoyed today's episode. Thanks for listening, and I hope to see you next week.